Very good morning, friends. So I hope you're all doing good. And of course, on the presumption that you made your revision on what we've done on consolidation so far, at least on the concept introduction to the consolidated income statement. Though I'll also give you a quick brief on what we discussed conceptually on the income statement before we'll take a practical illustration with you. We've already seen the aspects of consolidated balance sheet, how we are going to apply a 7-step model. And now I am focusing on the consolidated income statement. I've got two focus areas for the day. One is a consolidated income statement, and one is talking in terms of changes in the ownership interest of the investor. So we'll first concentrate on the consolidated income statement. And I'd like to remind you the 3 focus points which we need to keep in mind, because when we're going to attack a question on a consolidated income statement, these 2 important focus points, 3 important focus points need to be kept in mind. So I think let's first take a little recap in terms of those 3 focus points and then take the inputs further. I guess I got some request from Sania, I think, telling me to do the May 24 examination paper, question 1 consolidation as well. We'll take it up, but not immediately. I'll have a little constraint of time as well. So we'll take that up as well, maybe not today, if in the next class possible. Okay, so I think let's first begin with the inputs to you. So I am going to first give you some insights on what we discussed last time as well, that when you're making a consolidated income statement, then what are the focus points? So when you're going to do the question on a consolidated income statement, these focus points must be very clearly kept in the mind. So I would say when you're doing a consolidated income statement, the concept is largely the same. Just like a balance sheet, you aggregate assets and liability. You need to aggregate the incomes and expense as well. But one focus point, the focus point number 1. So I'm just making a list of the focus point. So the first focus point number 1 is when you are making a consolidated income statement, watch on the date of acquisition. The very first thing you're going to do in every question is look at the date of acquisition. And why do we look at the date of acquisition is for the reason that your date of acquisitions could be, I would say, 2 categories. One is it is before the current year, or it is in the current year. So we need to be careful that is the date of acquisition before the current year, or is it after in the current year? So won't we get a 3 by 7 step model for consolidated income statement? Back to the 3-step model. So as far as the date of acquisition is concerned, if it is before the current year, we can definitely say the entire current year is post-acquisition. Once you say that the date of acquisition is supposed to be before the current year, we can outrightly say that the entire current year is post-acquisition. You can comfortably add the parent and subsidy figures 12 months. Because the entire 12 months of the current year is post-acquisition, so you can aggregate it entirely. But if it is in the current year, then we can say part of the current year. Then we can say part of the current year is post-acquisition in nature, and part of it is pre-acquisition in nature. And there you need to be careful that when you consolidate the income statement, we take the holding plus the holding that is post-subsidiary, that is post-acquisition period. So let's say if the acquisition is middle of the year, you will just take the 6 months figures of incomes and expense. So remember, if it is in the current year, you are going to consider according to the number of months. If it is supposed to be before the current year, you can consolidate entire 12 months itself. So your first focus should be very clear as you proceed with the question. You need to immediately see that acquisition date is before the current year, consolidate 12 months figure. It is in the current year, then you need to see the number of months. Whatever is the post-acquisition, you need to consolidate that. Focus point number 1. Now, let's come to the second focus point. The focus point number two, what you need to keep in mind. The focus point number two, what you need to keep in mind, when you're going to consider the sales and the cost of sales, you need to eliminate the intercompany sale and purchase. But at that stage, you don't need to bother whether it is upstream or downstream in nature. But you need to be careful in terms of what you eliminate from the sales and from the cost of sales figure, and how do you tackle the stock reserve figure as well. So I would say the second focus point is in terms of intercompany sale and purchase. So we need to be careful on the intercompany sale and purchase, and you've got a total of two focus points out here. When you consider the figure of sales and when you consider the figure of cost of sale, one thing is common as far as the cost of sale and the figure of sale is concerned. You need to eliminate the selling price of the goods from the sale. Whatever is the intercompany sale purchase, eliminate the selling price. Even from the cost of sales, I'll do the same thing. I will eliminate the selling price of the goods. So are we eliminating a common figure? Is this a common figure which we are eliminating from both the sales and the cost of sale? Yes. So effectively, when you go to eliminate the common figure of selling price, it has made no impact on the profits of the company. So what do you need to do next? The next thing what we need to do in this particular case is, in the cost of sales, you are going to add the stock reserve, irrespective it is upstream or irrespective it is downstream in nature. So the treatment for the income statement remains the same, because you're making a consolidated income statement. Up or down doesn't make a difference. But remember one thing, the elimination of the sale and purchase will take place irrespective the goods have been sold to a third party or not. So when you're going to eliminate the sales, you will eliminate the common sales between each other, because that's not a group sale. That's not a sale to the outsider. So the elimination of the sales will be always full, but stock reserve will be always to the extent of the unsold goods, if any. So let me pinpoint that part as well. So when you're adding the stock reserve, it is on the unsold goods, if any. It is on the unsold goods, if any, that you'll take care of the stock reserve. But when it comes to the elimination of the sales and purchase, the common selling price, it is 100% of what is sold, irrespective it has already been sold to the outsider. So this is the focus point number two when you're going to consider revenue and the cost of sale. Remember, eliminate the sales from both sales and the cost of sale, but remember to add the stock reserve up or down, irrespective. Then comes another important focus point, and that is the focus point number three, which is very crucial, which of course I will explain in detail when I come to the practical question. But this is a very important focus point, because this is one thing which you will see in every question on consolidated income statement. So once you reach the profit figure, once you reach the profit figures, you've taken the consolidated revenue and you've reduced the consolidated expenses and you reach the profit figure. Now this profit belongs to the parent company and this belongs to the NCI of the subsidiary company. So what we technically say that this profit is attributable. What we say that this profit is attributable, you can say to the parent company and the NCI. You need to segregate what is attributable to the holding company and what is attributable to the NCI. Now, we need to be a little careful. Now, I'm just going to add some more inputs at this stage. The subsidiary company has got a reported profits, but the NCI is not going to be given a share in the reported profits of the company. He is going to be given a share in the rectified profits of the subsidiary. Now you would say, what do you mean by a rectified profits of the subsidiary? You know, when you look at the reported earnings, there are a couple of adjustments which are yet to be taken care. Like for example, When you consider a fair value adjustments, then there is a need to consider an additional depreciation as well. The reported profits of the subsidiary would be without considering the impact of additional depreciation, because the fair value adjustments is done for a consolidation point of view. But from the standalone point of view, the fair value adjustments would not have been taken care. So what you need to do when you go to consider the share of the NCI, you need to consider first of all the share in rectified profits. I'll call it as rectified profits. So remember, the focus point is that you need to consider the share in the rectified profits. Now, there are a couple of adjustments which you need to consider in the calculation of the rectified profits. So what I'll do, when I'm going to calculate the rectified profits in this case, we will take the reported profits as a base. We will take the reported profits as a base. And the first adjustment which you need to make is regarding the additional depreciation due to fair value adjustments. The additional depreciation which is due to a fair value adjustment. Since the subsidiary company's reported profits will be without considering the impact of the fair value adjustments, you need to consider the additional depreciation impact on this profit. So that is one adjustment. Second, we know that the subsidiary's profits is after considering all the sales, including the upstream transaction which they might have sold to the parent company. Now, I'm not going to give the share to the NCI, including the unrealized earnings. So what I need to do at this stage, I also need to make a reduction of the stock reserve, which is on account of the upstream transaction, not downstream. It's only going to be upstream transaction in nature. And last but not the least, I would say you also need to consider the goodwill impairment. You also need to pass on to the NCI the goodwill impairment if NCI is at fair value. If NCI is at a fair value, because if it is at PASNA, then I don't need to give them the share in the impairment of goodwill. So these three items are to be subtracted in terms of calculating the rectified profits. We'll see that in a practical illustration, but get the focus clear that when you are calculating the share of the NCI in the post-acquisition earnings, you need to consider these three adjustments, convert the reported profits into a rectified profits. Take care of the additional depreciations if there are fair value adjustments. Take care of the goodwill impairment if the NCI is at a fair value, and also take care of stock reserve which is upstream in nature, so that we can get the profits which is rectified and give the NCI a share in terms of that profit. So I hope you got conceptually the three focus points on a consolidated income statement. Watch the acquisition date for the number of months. Watch out the inputs in terms of intercompany sale purchase and the stock reserve inputs. Watch out when you split the profits between the parent NCI, three focus points in the calculation of the rectified earnings. I think now we should take up a practical illustration on this. I'm carrying a small little question at my end, which I will just do it with you so that we get a good idea in terms of making a consolidated income statement. So let me just, I think, crop this a bit to make it more zoom. Okay, that's perfect. Let's, I think, zoom this further. I hope it is clearly visible to you. Let me know, friends, if this is clearly visible, right? No, still not. Okay, then I'll cut down the requirement of the question, I guess, to make it visibly clear. Okay, I guess good to go. This should be good, I think. Visible, wonderful indeed. Now, let me read the inputs in this question. Of course, we've not taken the complications in terms of other comprehensive income so far, but I'll give you a brief on that as well, not a big deal. It says H owned 80% shares, ordinary shares of S, and has got 30% ordinary shares of A. Now, as I took this question, I thought, I'm just going to add something more early in the morning. I know we have not done the concept of Ind AS 28, which talks about an associate company. But in this case, I have taken intentionally, there are two investments. One is investment in a subsidiary and one is investment in an associate. Now, because it is not very complicated, I thought I'll just add that. But let me just give you a small brief before I go further to the question. Now, when you say that an investor, let's say, for example, H has got two investments. One is an investment in subsidiary, which is to the extent of 80%, and one is in the associate, which is to the extent of 30%. Now, we will cover Ind AS 28 later, but first of all, when you say 80%, it establishes a control. When it establishes a control, then consolidation as per Ind AS 110 takes place. And this consolidation is based on the technique which is called a full consolidation technique. And you're already now aware in terms of how the full consolidation is done. But when it becomes a 30%, it is called a significant influence. And we will be seeing later that in this particular case, Ind AS 28 would trigger. The moment you say it is a significant influence, it creates a significant influence, that is Ind AS 28, and we need to do a consolidation which is called one-line consolidation. It is also called an equity method of consolidation. So we'll be learning that concept of equity method later, but let me just explain what is one-line consolidation. Simple. When you're looking at Ind AS 110, you're aggregating all the incomes and expense. But when it comes to an associate relationship, what I'll do, I'll just consider a one-line consolidation. The share of the investor in the investee post-acquisition profits. Just a single line in the consolidated P&L. So what we'll just do, no aggregations of incomes and expense. We'll just figure out that what is the post-acquisition profits of the investee. And I will take a 30% share in the post-acquisition profits of the associate company and put it as a single line in the consolidated income statement. So I thought that was not very technical. Now, we'll see all the details when we come to Ind AS 28, but as of now, we're going to just take that one-line consolidation in the income statement. Let's come back. So in this particular case, it says it was acquired many years. I think that puts us to the first focus point. If it was acquired many years ago, then I can undoubtedly say that the entire 12 months of the current year is post-acquisition in nature. I can easily consolidate all the 12 months. The information below is required to make a consolidated statement of P&L for the year ended 30th June X8. So we're given the income statement of the parent company, subsidiary, and the associate. And then it says there were no items of other comprehensive income in the year. At the date of acquisition, the fair value of the plant and machinery, which at that time had a remaining useful life of 10 years, exceeded the carrying amount by 10,000. So this is the fair value adjustments. The moment you hear about the fair value adjustments, you need to consider the additional depreciation, not only for the rectified earnings, but also when you go to consider the expenses in the income statement. Then he says, during the year, S sold goods to H, which means it is upstream transaction in nature. So we've got fair value adjustments leading to additional depreciation, rectified earnings. We've got a stock reserve as well, which also needs to be considered in the rectified earnings and of course in the cost of sale. So during the year, S sold goods to H for 10,000 at a margin of 25%, and by the year end, H sold 60% of these goods. So what is unsold at the end of the year is supposed to be 40%. So when I'm going to consider a stock reserve, we will take only 40% into account. Then he says the group policy is to measure the NCI using a proportion of net asset method, that is PASNA. The current year goodwill impairment loss is 1200 and this should be charged to the administrative expense. So there is goodwill impairment as well. But since the NCI is at PASNA, the goodwill impairment is not to be borne by the NCI. So not to be taken in the calculation of the rectified earnings. So this is regarding the goodwill impairment loss, but will not impact the NCI calculations. Then he says by 30th June, the investment in A, which is associate, is also been impaired by 450, of which the current year impairment loss is 150. So we're also given the impairment of the investment in the associate. We'll take care of that in the one-line consolidation figure itself. Then he says on 1st January X8. So we are looking at the year ended 30th June X8. And then it says on January X8, that is on 1st January, H signed a contract to provide a customer with the support services for the next 12 months. That means January to December X8. H received the full fee of 30,000 in advance and recognized this as a revenue as well. Now he got a 12 months money, but out of this we can say the next 6 months revenue, 30th June onwards, is supposed to be an advance for the next year. That cannot be taken as a revenue, which means the revenue of the parent company stands inflated to the extent of half of this full fee, because only 50% is for the 6 months, the rest 50% is for the next 6 months, which is in advance. Now on this basis, we need to make a consolidated profit and loss account for the year ended 30th June X8. I guess we're fairly clear. We're given a couple of adjustments, like we are given the inputs on the additional depreciation. We're given the inputs with regard to the impairment, which is taken in the administration, and some sort of revenue adjustments to the parent company. Now let's watch how we are going to make a consolidated income statement in this case. So I'm going to make first of all a sheet with the help of which we will make our consolidated profit and loss. There is no OCI section in this particular question. We'll talk about the OCI section also after the end of this question. If there is something as far as OCI is concerned, we'll take care. So let's do one thing. Let's make a format for the consolidated P&L. We're going to take a column for particulars, a column for the holding company, a column for the subsidiary, a column for the adjustments, and we're going to take a total column as well. There is no consolidation column taken for the associate, because associate is supposed to be a one-line consolidation. So we're just taking a balance sheet kind of a format. So let's take particulars. Let's take the holding company, the subsidiary company, the adjustments, and the figure which will appear in the total column as well. So we'll go one by one. We'll pick up the figures and look at the additional information and concentrate. So let's go back. So we know, first of all, the revenue is supposed to be 5 lakhs and 2 lakhs. We're not taking the associate. We've already seen the focus point 1, that consolidation for the subsidiary is going to be taken for 12 months because the acquisition is many years back. So let's take 5 lakhs and 2 lakhs. So we take the revenue. This is supposed to be 5 lakhs and this is supposed to be 2 lakhs, and there is an adjustment. What is the adjustment given in the last para? On 1st January X8, H signed a contract with the customer with a support service fee for the next 12 months. H received a full fee of 30,000 taken as a revenue, which means 5 lakh rupees includes this entire 30, but we should have taken only 15. So there is a need to eliminate 15,000 out here. So this will take it in the adjustments. This is revenue, which is wrongly recorded in the books. So 5 plus 2, 7, 7 minus 15, and that works out. And there is some intercompany owings as well. Let me also see. Yes, there is an intercompany owing. It also tells you about the intercompany owing during the year S sold goods to H for 10,000. Now, when you're eliminating that intercompany sales purchase, I'm not concerned upstream, downstream. I'm not concerned whether what portion is unsold. We need to eliminate the full amount of intercompany sale purchase. That is 10,000. So let's also eliminate this 10,000 as well. This is supposed to be the elimination of intercompany sale and purchase. This is the elimination of the intercompany sale and purchase. So let's see the figures. 5 plus 2, 7, 7 minus 25, it works out at 675. So this is the very first input, that is revenue. Let's go back. Now we are given the cost of sales, and in this particular case, the cost of sale is 1,80,000. Now we need to be careful. So when you consider the cost of sales, this is supposed to be 1 lakh, and the cost of sales for the other company is supposed to be 80,000. Now we need to consider the element of stock reserve, and we need to eliminate the intercompany sale purchase. First, what we'll do, we will eliminate this intercompany sale purchase, that is 10,000, same figure. Now we need to consider the element of stock reserve, and you're going to add the stock reserve. Doesn't make a difference, it is downstream, upstream in nature, but we need to consider the stock reserve. So it says during the year S sold goods 10,000 at a margin of 25%. That means 2,500 is the profit. By the end of the year, H sold 60% goods, so 40% is unsold. So out of 2,500 profits, 40% is unsold. So if you take 2,500 into 40%, that is 1,000. So what we need to do, we need to add the stock reserve, which is to the extent of 1,000. Now you can clearly see something which I pinpointed earlier as well. When you're eliminating 10 from the sale and 10 from the cost of sale, the impact on the profit is 0. Now when you add the stock reserve 1,000 to the cost of sale goes up. When the cost of sale goes up, the profit automatically comes down, and the elimination of unrealized profit gets taken care. So this is one. Let's see any further inputs as well. There are two more adjustments. One is regarding the impairment, and one is the additional depreciation as well. So we need to be watch out careful that any particular adjustment is relating to any of these common expense heads as well. Impairment is very clearly said would be a part of the administrative expense. But as far as depreciation is concerned, we need to see which is the appropriate head for depreciation. I guess as far as depreciation is concerned, it cannot be a part of the distribution cost. It cannot be a part of the administration, because this is a plant and machinery. So if it would have been a furniture, fixtures or something, administration could have made sense. But since it is specifically given that this is plant and machinery, it cannot be administrative expense as well. So I guess the only expense head which is appropriate is the cost of sale. So we need to make some analysis in this case. The depreciation on a plant and machinery cannot be distribution cost, cannot be administration cost. So it has got to be some other heading, and the only other head left over is the cost of sale. So we'll consider the additional depreciation as a part of the cost of sale. So we're given that the plant and machinery exceeded the book value by 10,000. That is the fair value increase, and the remaining life is 10 years. So we need to consider the additional depreciation. So that's going to be 1,000, which is additional depreciation. I'll just show the workings out here. So the increase is 10,000 divided by a life of 10 years. We get the additional depreciations as well. Great. Let's now see what is the cost of sales we are getting. I guess this is coming to 180 minus 10 and plus another 2. That makes it 172 is the cost of sale. Great. So now with this particular inputs in hand, we are done with the first set of calculations. The focus point 1 is done. The focus point 2 is done. NCI awaits still. Then we got a gross profit. Of course, under the Indian scenario, we don't take a GP. This is a question which I took more from the international front. Therefore, you see a gross profit in the income statement, but we don't have GP. That's okay. It's simple. Okay. So let's now go for the distribution and the administrative expense as well. So let's take the next item of expense, that is distribution expense. And we'll also consider the next expense, that is administration expense. So on the distribution expense, I think nothing is given. So we can directly take 160 plus another 20. So this is 160 and this is 20. There are no adjustments. So that comes out at 1,80,000. This is the distribution expense done. Similarly, we can go to the administrative expense as well. That's 140 and 40. So this is 1,40,000 as well as 40. And we need to consider something in the adjustments, which is as regards the impairment of the goodwill is concerned. We're given something as far as goodwill impairment goes. So let's have a look on the goodwill impairment. It says the group's policy is to measure the NCI using PASNA. The current year goodwill impairment loss is 1,200 and this should be taken as a part of the administrative expense. Very clearly given that this 1,200 goodwill impairment should be taken as a part of the administrative expense, so add it out here. So this becomes 181,200. That is the amount of administrative expense. Great. So let's see what more expenses are given out here. I guess that's it. Nothing else is further given to me. So we can just now get the profit from operations. So let's take this figure. I'm not interested in the individual figures of holding subsidiary. Let's directly get the profit from operations. Then we'll also take care of the associate share in the profits as well. So let's see what is the profits at this stage. 675 minus 172.
141,800.
Okay, great, beta. 141,800. This is the profit from operations. Great. I'll now take this further. Let's extend the format further out here. And then we'll take the other items as well. So we've got the extended format, particulars, the parent company, the subsidiary company, the adjustments, and we consider the total as well. So we take the particulars. This is holding, subsidiary, adjustments, and the total. This was 141,800, right?
Yes, sir.
Great. So this is the profit from operations. And now we will consider the other items in the consolidated P&L. But I think before that, let's also consider that, in this 28 part, we've got an associate. You need to consider only the post-acquisition share as one line. So let's go back and pick up the figures as well. So before I take care of the tax part, I'm just going to go below and see the associate companies, any adjustments. There is a goodwill impairment for the investment in associate, the impairment of investment, which we'll take care. Now, if I look at the share in the post-acquisition earning, the associate company's income statement is already given. So what I need to do, out of this 26,000, the investor has got a 30% stake. So in the consolidated income statement, I will simply take the share in the profits of the associate, whatever is the post-acquisition share. And also we are given out here that it says on 30th June, investment in the associate impaired by 450 and the current year impairment loss is 150. So we need to take care of that as well. So let's add the share in associate company, whatever is the profit share in the associate company as a one line consolidation. So out of 26,000, I guess, let me show the workings. Out of 26,000, we said 30% belongs to the investor, but there is a goodwill impairment, not goodwill impairment, I would say investment impairment. So let's see the investment impairment minus 150 for the current year. So this is supposed to be the impairment of the investment. Let's see what is the share in the associate. This is one line consolidation. This what we're going to see later in detail as per Index 28. So 30% less 150, I think 7650.
Yes, sir.
Great. So this is the share in the profits of the associate as well. And now I think we'll get the PBT, the profit before tax. So let's see what is the PBT. $149,450 is the profit before tax. Let's go back to the income statement again and see what is left over. Now we got tax, which is 23 plus 21. So 23 plus 21 is the tax. So taxes to the extent of 23, and this is 21. There is no adjustments. It is 44. So let's get the profit after tax as well.
Sir, it is 1,05,450.
Okay, great. 105,450. So this is the profits of the company. I can call it as PAT. That's a profit after tax. Simple. I think if you compare this with a consolidated balance sheet, it's not a big problem because this is, just keeping those 2-3 focus points which I gave you. Now we're going to go back to the question and see for anything which is left over. Otherwise, it's time to split the profits between the parent and the NCI, for which we'll need the rectified earnings of the subsidiary as well. But let's first scrutinize for anything left over. So as far as the additional depreciation is concerned, done. As far as the stock reserve is concerned, done. As far as the impairment of goodwill is concerned, done. As far as the impairment of investment associate is concerned, done. And the elimination of that advance is done. So everything is taken care. Now we need to split the profits between the parent NCI. So what are the profits of the NCI? Now watch this. If I want the rectified profits of the subsidiary, this is the profits of the subsidiary, that is 39. So what I need to do from this 39, I need to reduce the additional depreciation, 1. I need to reduce the unrealized profit upstream in nature, 2. And I need to take care of the goodwill impairment if it is at a fair value, 3. But in this case, the goodwill is not a full goodwill because NCI is at PASNA. So let's see what is the rectified earnings. So what we'll do in this case, we will split this profits attributable to. We will split the profits which is attributable to the holding company as well as the NCI. So we're going to first of all calculate the profits which belongs to the NCI in this case. So let me show the workings out here. So I will first of all consider the reported profits. So we will first of all consider the reported profits, that was 39,000. So let's eliminate the stock reserve. I think that was 1,000. Let's consider the additional depreciation. I think that was also 1,000. So we get the rectified profits. So we get the rectified profits, that is to the extent of 37,000. So out of this 37,000 now, we need to consider the NCI share. So what was the NCI share? I guess 20%. So we take a 20% share of the NCI. So what belongs to the NCI is 7,400. The balancing figure, out of this 105,450, 7,400 belongs to NCI. The balancing figure belongs to the parent company. Every time you can take the NCI and the parent can be taken as the
98,050.
balancing figure. 98.
050.
050. Great. So this is how the profits are divided between the parent and NCI. You will always calculate the share of the NCI in the profits by considering the rectified profits of the subsidiary, get the share. So whatever is the share of the NCI, the balancing figure automatically goes to the parent company. Right? I hope I am pretty clear with the technique of consolidation, though in this case I did not take OCI. But I'm just going to add some arbitrary figures to extend this question to explain that if there was an OCI as well, how would things look like? So let's take this further. Now let's consider that in the consolidated income statement, you're also given information on the other comprehensive income as well. So what would I do in that particular case? Watch this. So let's see that if you're looking at a consolidated income statement, including the OCI. So like for example, in this case, we have taken the profits for the year. I'll just take the figures from the back. The profit is 105,450, 105,450. And let's say we've also got other comprehensive income. I'm just assuming some arbitrary figure. Let's say the OCI of the parent company and let's say the OCI of the subsidiary company. Let's say this is 10,000 and let's say this is 2,000. So we will add this and take this as 12,000. I'm just taking this arbitrary figure. These are just assumed figures. So we will get what is called a total comprehensive income. So once you add this, we're going to get the total comprehensive income. So add the profits and the other comprehensive income. I think this is 117,450. Now, the only thing what you need to do is present the data like this. Now, watch this because this is a little crucial presentation. What I need to do, I need to first of all divide the profits, which is the profit and loss section. So we will say what is the profits which is attributable to. We will divide what is the profits attributable to holding and the NCI. So we'll give the breakup of this 105,450. So you need to give a breakup of this figure. Second, we're again going to consider the profits which is attributable to. We'll also consider the profits which is attributable to the holding and the NCI. And now we need to consider the breakup of this figure, that is 117,450. We do not show the breakup of what is attributable to parent NCI for the OCI. So if you've got two sections in the income statement, P&L and OCI, so what we'll do, we'll calculate the P&L, we'll calculate the total comprehensive income. You need to show the split of this between parent NCI and you need to show the split between this between parent NCI. OCI split is not to be shown. So we will only show the profit and loss section breakup and the total comprehensive income section breakup. We'll show the breakup of this between parent NCI and the breakup of this between the parent NCI, not the OCI. So I'll take these figures from the back, 98050. So this is 98050 and this is 7400. Now let's see how we are going to get the inputs about the total profits. I will again calculate the NCI. I'll again calculate the NCI for this purpose. The NCI was 7400 already. The NCI was 7400 already. Now, out of this 2000, of course, assuming that there is no rectification, so the NCI gets a 20% stake in the other comprehensive income. So I think this works out at 7600. No, it's 7800, right? So this will be 2000 into 20%. It comes to 7800. So what you can do, you can take the share of the NCI in the P&L, add the share in the OCI, get this total 7800 and again take this as a balancing figure. See what is the balancing figure.
So it is 1,09,650.
Great. So 109,650, this is the profits which is attributable to the parent company in the total comprehensive income of the company. Right. I hope you got the picture clear of how the consolidated income statement is done. So far, so good, I guess. Right. Are we good to go ahead? Wonderful indeed. Okay, now this was one agenda of discussion, that is in terms of consolidated income statement. So we've done the flare of balance sheet and the income statement. Now I want to take you further, because there is another area of section in the standard. You know, when I started with Indias 110, I said that there are four areas of discussions. One is we need to understand the basic scope of the standard. And then we went ahead with the concept of a control assessment. Then I came to the inputs in terms of how the consolidation of a balance sheet and an income statement would take place. Then now we're going to go to the fourth agenda in hand, which is the changes in the ownership interest of the entity, for which I'm going to first give you a framework. Then we're going to do a couple of questions on that area as well. So let's now go to the next area of discussion. I'm now coming to the fourth agenda, that is called changes in ownership interest. The changes in ownership interest. That as an investor, if there is a change in the percentage of holding, then what happens? Let me first give you a complete picture of thought, because I'm going to make your life simple and I'm going to do a lot of questions from the study material also today, because there is a particular unit, I think it's a unit number 4, in which there are a lot of questions which are given on the concept of changes in the ownership interest. So what I'll do first, I'll give you the larger concept, give you the crux, and then we'll do some questions with you on that area. Now, first, let's understand one thing. I would segregate the entire discussions in terms of two parts. When I'm looking at the changes in the ownership interest, my focus is working in terms of two parts. When a subsidiary, when a parent company, makes a purchase or a sale in the subsidiary, a further acquisition, step acquisition, it may make a further acquisition or a disposal, but the percentage changes, but the control doesn't go. So one of the cases would be that there is no loss of control. So that means I had, let's say, a 70% stake, I acquired another 10%. I still have a control. Or I had, let's say, a 70%, I made a sale of 10%, I'm at 60, I'm still under control. The other case can be that you make a disposal of shares and it results in a loss of control. It was a subsidiary, now it is no longer a subsidiary. So I'm going to first give you a permutation, combinations which we need to visualize, and then we'll see how do we tackle each and every situation in that. So I would say one case is that there is no loss of control. One case is that there is no loss of control, and the other one is that there is a loss of control. Now, when you say that there is no loss of control, there can be two situations. I would say there can be two situations. It could be a case of further acquisition, or it could be a case of disposal as well, because you may not lose a control even if you sell shares. So when you acquire shares, then also, and if you dispose shares, then also. Now, let me make it one thing very clear. When I am looking at the first situation, a further acquisition, it is something like, example, you had a 70% stake and you acquired another 10% stake. You were still under control and you continue to be under control. So there is no status change. There is no status change. It was a subsidiary earlier. It is still a subsidiary. No change in status. You're still within a particular standard. Now, when you say disposal, it could be from a 70, it turns out to be 60%. You were having a control and you still got a control. So there is disposal, but the status does not make a change. Okay, I think Sana, you said, so when making income statement, can we put the figures which needs to be deducted in brackets? Of course you can, that's not an issue. Okay, now coming to the concept that if there is a loss of control. Now, when you say there is a loss of control, I would say that there are two permutation combination. There may be a complete disposal or there may be a partial disposal. Rather, if you ask me, I would actually say that there can be two kinds of disposal. Now, watch this. I could say that there is a deemed disposal, or I would say there is an actual disposal. Now, you will say, what do you mean by a deemed disposal? A deemed disposal is that I don't sell. But let's say, for example, there is a change in the structure of the company. The company has issued some shares which goes to somebody else, and I, in the entire process, lose a control without taking any action in life. So there is a question in the study material also which explains the concept of a deemed disposal, which means you don't sell, but something happens and you lose control. Or there could be a case of actual disposal as well. Now, when I'm going to look at the actual disposal, there will be few more combinations coming in. And the combinations could be, so I would say the combinations would be, it could be a case of full disposal. It could be a case of a full disposal, or it could be a case of a partial disposal. Rather, let me write down partial here and let's write down the full disposal here. So it could be a full disposal or it could be a case of a partial disposal. So a lot of permutation combinations coming in. Now, when you say it is a case of a partial disposal, there could be a lot of combinations. Like, for example, it could be a conversion into an associate. Like, for example, it could be a conversion into a passive investment. So when you say that there is a partial disposal, I would say there will be two more permutations and combination. So one is that it is converts into associate. It converts into an associate company. And the other one is that it is converts into a passive investor. It converts into a passive investor in this particular case. Now let's, I think, first look at this entire chart in a consolidated view. There are a lot of permutations and combinations coming in. But trust me, all these permutation combinations can be divided into basically two simple accounting treatments and your life can be made jingalala. Let's first have a look out here in terms of all the combination. So I am looking at two broad situations. Number one, as an investor, I may acquire or I may sell shares, but my control doesn't change. I was in control of the investee even after a further acquisition or a disposal. I still continue with the control. So this is the case when there is no loss of control. You further acquire or you sell the shares, but the control continues in both the cases. That's one block. That's one block. Second, there may be, a sale, not a purchase. There may be a sale. I'm not talking of further acquisitions. I'm talking of a loss of control. So here we're not talking of any case of purchase. So in this case, when you say there is a disposal, it could be a deemed disposal. I don't sell, but something happens due to which I lose control. Or there may be actual disposal. If it is actual disposal, you may fully sell the shares. It could be a full disposal, creating that the relationship is gone, or it may be a partial disposal, converting the investor into a different relationship. So from a control, you get a significant influence. You switch over from 110 to 28. From a control, you become a passive investor. You switch over from 110 to 109. Because in this case, when it is a passive investment, it is 109. In this case, it is India's 28. Now, friends, let's make your life simple. I will basically deal with two cases. Block number one, a common entry when there is no loss of control, a common entry when there is a loss of control. Though I'll do questions on each and every combinations with you. But I think to make your life simple, let's consider only two blocks. You can do all the questions with two blocks itself. Let's begin the journey. I am looking at, first of all, the block number one. I'm first of all looking at the block number one. That is, there is no loss of control. That is, there is no loss of control, in which you've got two inputs. One is a case of further acquisition and one is a case of disposal. So I'm looking at, one is a case of a further acquisition and one is a case of disposal. Now, hear this carefully. This is very simple. The entries which I am giving you is all for consolidated financial statements. I'm not giving you entries in terms of standalone financial statement. If you sell or buy shares from a standalone financial statements point of view, it's a normal entry. Investment debit, bank credit, or sale would be bank debit, investment credit, the difference in the P&L. I am giving you entries only with reference to consolidated financial statements. So all the entries which I am going to give you in block number one or block number two is from the point of view of the consolidated financial statements. Now, let's get one thing very clear, because this is sometimes a point of confusion for many. Because you've done accounting standard 21 in terms of IGAP, so this could lead to a confusion. So let me make one thing very clear. If you get a control over the company and you acquire further shares, goodwill is not going to undergo a change. What you identified as a goodwill is done. So when you acquire further shares, don't get into the trap of calculating any further goodwill. The only thing which will change is the NCI. The standard makes it very clear that when there is no loss of control, that means you are buying shares from the NCI or you're selling shares to the NCI. So the only thing which changes is the NCI. So if there is going to be a further acquisition, the NCI will reduce. And if there is going to be a disposal, the NCI will increase. That's it. No impact in terms of goodwill. So what we're going to do in this particular case, when there is going to be a further acquisition, I am going to put the entry debit the NCI, because NCI needs to be reduced and the bank is going to be given a credit. This is with the amount of cost which is paid to acquire these further shares. This is with the amount of cost which is paid to acquire the shares. Now comes the question that what is the value at which this NCI is going to be recorded? And there is what people tend to get confused. Now please hear me carefully. The NCI calculation depends upon whether NCI is at a fair value or NCI is a PASNA. So when you're calculating this NCI, you're debiting the NCI, your focus needs to be very clear that is the NCI in the question at a fair value or is it at a PASNA? If the NCI is at a fair value, in this particular case, you will calculate the share of the NCI in the net assets plus the goodwill and debit the NCI by that amount. I will say, okay, this is the net assets and goodwill on the date of further acquisition. See what is the net assets and the goodwill on the date of acquisition, calculate the percentage in that. If the NCI is at a PASNA, you just need to consider the net assets. The goodwill in this case is not to be considered. How do we exactly do this? We'll see in a question. But remember, when the NCI will be given a debit, you need to be very careful that the NCI in the question is at fair value, then take net assets plus goodwill. If it is at PASNA, then take only net assets without goodwill, because NCI goodwill is not even appearing in the balance sheet of the company. And of course, there would be a difference in this entry as well. Any balancing figure in this entry is going to be taken directly in terms of equity. It's not going to go in the P&L. The reason is that the shareholders are dealing with each other. You can say the majority, the controlling, is dealing with the minority that is non-controlling. So it's a deal between the stakeholders, the two shareholders of the company. So any gain or loss arising on account of this will be entered directly in SOKI, that is in the retained earnings. You can directly adjust this amount in equity, that is statement of changes in equity. It's going to be taken directly in equity SOKI. It can be adjusted directly in terms of retained earnings. Same funda goes in terms of disposal as well. If there is a disposal of shares, that means I am going to sell shares, I'm going to get some money, and the NCI will increase. So I'll put the entry in this case, bank gets a debit. This is with the amount of sale proceeds which you will get on sale of the stake, and the NCI will increase. So NCI will be given a credit, and the NCI credit is also going to be on the same lines. Your NCI will be increased by, depending upon the status, is it at PASNA or is it at a fair value? And any difference in this entry is again going to be taken as equity. Any balancing figure in this entry is going to be equity, which will be adjusted in terms of SOKI, that is retained earnings. It doesn't enter the profit and loss account. It's going to be adjusted directly in the retained earnings. I hope I made the point clear. So get your focus clear that if there is no loss of control, in that particular case, it's a dealing between two shareholders, controlling and non-controlling. A further acquisition would mean decrease in NCI. A disposal would mean increase in NCI. You just need to be careful. How will you calculate the NCI? And that all depends upon NCI is at fair value or PASNA. Simple. Any balancing figure is a profit or loss adjusted in RE, retained earnings, directly. You want me to first do a question, friends, on the block number 1, or can I give you the concept of the block number 2 and then do questions with you? So you want me to do questions directly on the block number 1 first, or give you the concept of block 2 and then do questions on that? Block 2. Okay, let's take you to the block number 2 as well. Now I'll explain what is there in terms of block number 2. You've seen permutations and combination. Trust me, I don't care whether it's a deemed disposal, actual disposal, full disposal, partial disposal. I don't care. I'll give you a simple thumb rule in terms of dealing with the block number 2. Now watch this. Watch this very carefully. You know, when you acquired a control, you did the entry under Ind AS 103, which is the acquisition accounting. When you acquired a control, you did an Ind AS 103, which is acquisition accounting. So what are you going to do on disposal? Reverse that entry. Simple. So in this particular case, when you did this acquisition entry, you said it is net assets gets a debit. This is the fair value on the date of acquisition. And then you also consider the goodwill as a balancing figure, though it was computed as well. And you took the credit to the NCI, that is the amount of NCI at fair value or PASNA, whatever the case might be. And then you also consider the purchase consideration, which is the investment, basically, the investment which you acquired. So this is the journal entry which was done when you acquired a control. Net assets at a fair value, goodwill gets a debit, NCI and PC gets a credit. I would now say, irrespective, it is a case of any permutation combination. So when you are going to do the disposal under Ind AS 110, when there is going to be a disposal under Ind AS 110, and this disposal means the control is gone. This disposal means that the control is gone. My advice is you just reverse this entry. That's it. You just reverse this entry. So what I'm going to do, I'll give you a single entry applicable to all cases. You know, all the cases which you saw, whether it's a deemed disposal, whether it's a full disposal, whether it's a partial disposal, converting into associate or converting into passive investor, common entry for all. So what I'll do, I'll put the entry bank account gets a debit. This is with the sale proceeds. You're selling the shares. This is the sale proceeds. And again, let me remind you, all these entries are in the consolidated financial statements. For individual standalone financials, normal entries will be done. So bank gets a debit, and I will also give a debit to investment. This is the debit to the extent of the investment retained, if any. Because if it is a conversion to associate, or if it is a conversion to a passive investment, you will also debit the investment. This is going to be debited at the fair value for the investment retained, if any. Then in this particular case, the NCI needs to be derecognized, the goodwill needs to be derecognized, and the net assets needs to be derecognized as well. So what I'll do, I will basically reverse the input. The NCI, which is a credit in the books, debit. The goodwill, which is a debit in the books, credit. The net assets, which is debit in the books, credit. So this is basically derecognition. This is going to be basically derecognition of all these items in the books. The goodwill, the NCI, and the net assets is getting derecognized. So what values are you going to derecognize? So we will consider the net assets which we are derecognizing on the date of disposal. We will consider the credit of the net assets on the date of disposal. We'll also take the NCI as on the date of disposal. How would you calculate the value of the NCI would again depend upon whether NCI is at a PASNA or is it supposed to be at a fair value. So in terms of NCI, you need to again consider whether it is at PASNA or is it at a fair value. Accordingly, you will take net assets plus goodwill or just the share in the net assets. And this goodwill is supposed to be the figure which is as again on the date of disposal, which is after impairment loss, which is of course after impairment loss. So trust me, if you're looking at a situation that there is going to be a loss of control, I will focus on one entry only. I will simply look at debit the bank with the money received on sale. Investment will be given a debit to the extent of fair value of the investment retained. You need to derecognize the goodwill, NCI, and the net assets, and the figures are going to be as on the date of disposal, with a care to be taken that NCI depends upon PASNA fair value. Goodwill, which is there on the date of disposal, post the impairment losses, if any. Right, friends? I hope I am pretty clear with this. Now let's go back and see what we have done. If you notice, I've converted all this in terms of two entries only. When I'm going to read the question, I'll get only two focus points in the question. When I read the question and I see that there is no loss of control, NCI bank, bank NCI, difference in equity, finish. When I see that there is loss of control, reversal of Ind AS 103 entry, finish. Whether it is any of these cases, that is the key focus point. And let's go back and see if there is going to be a difference in this entry. So there is going to be a difference in this entry as well. The balancing figure in this entry is going to be taken in the profit and loss account. Because this is not a dealing with the equity shareholders of the company. It's not dealing with the NCI. So when there is a loss of control, any gain or loss arising is going to be taken in the profit and loss section. I hope friends clear on the agenda. Now I think let's do some questions with you. I am now going to take some questions based on the block 1 and block 2. Then I'm going to come back on the study material. Right now, I'm just taking some questions in a sequence. Some of these questions, of course, are from the study material. One or two questions taken from the education material also, just to give you a flair of things. So let me just come back now on the agenda. And let's have a look at the questions with you. So let's see the question in terms of no loss of control. So I'm going to pick up now two questions with you, one by one, of course, and we'll see how do we tackle the case when there is no loss of control. So let me just also keep the questions in front of me to start the picture. Okay. Let's, I think, begin the journey. We'll read the question carefully and then we'll also identify is it block 1 or block 2. Though I can tell you right now I am on the block number 1 cases. It says entity A acquired 60% entity B, which is 2 years ago for 6,000. At the time, B's fair value is given to us 10,000 and it had net assets with a fair value 6,000, which for the purpose of this example is same as the book value. It says at the time, entities B's fair value of the assets was 10,000. So naturally, out of this 10,000, he got a 60% stake. So he's got a share in the net assets at a fair value, which is 6,000. It says goodwill of 2,400 was recorded, which is 6,000, that is minus 60% of 6,000. A quick question comes to my mind. Is this goodwill full goodwill or is this goodwill a partial goodwill? See this carefully and analyze. He says the goodwill is recorded at 6,000 versus 60% of 6,000. He's comparing the PC versus the share in the net assets. So when he considers the PC versus share in the net assets of the company, in this particular case, what is the NCI? Pasna or fair value? Goodwill is full or is it partial in nature? And you said it's a full goodwill. I'm afraid no. Can I say in this particular case, when you consider PC plus the NCI at Pasna and you compare this with the net assets, you get the amount of goodwill. Now, if you remember my calculations carefully, alternatively in this case, can I compare the PC and compare the share in the net assets directly and also get the goodwill? Because what you're doing in this particular case, you add the NCI and then reduce the entire net assets. Or you directly take the PC and compare it with the share in the net assets, which means if you're comparing the PC with the share in the net assets, the NCI is at Pasna, the goodwill is supposed to be partial in nature. Correct? So we can very clearly say that this is indicative that the NCI is at Pasna and therefore the goodwill is supposed to be partial in nature. We need to identify this because we'll need this for the NCI calculations. Let's go further. It says on 1st October X0, entity A acquires a further 20% interest, taking the holding to 80%. At that time, the fair value of the entity is 20,000 and the entity pays 4,000 for 20% interest. At the time of purchase, the fair value of the net assets is 12,000 and the carrying amount of the NCI is supposed to be 4,000. So we're very clearly given that the carrying amount of NCI at that time is 4,000. We need to record the entries in the books of accounts. I think my life is simple. Since the NCI on the date of disposal is given, I'll put a question to you. Can I say earlier the NCI was supposed to be 40% because I had a 60% stake? Can I say now you acquire another 20%, the NCI becomes 20%? I'll put a very simple question to you, directly answer this. Can I say if the NCI is 4,000, now the NCI has become half, you should debit the NCI by 2,000. Agreed. I can simply put the entry NCI gets a debit and which is to the extent of 2,000 because there is a 50% reduction in the NCI. That's right. He is clearly given you that the NCI is 4,000, so you can debit the NCI 50%. And what is the money which is paid to acquire this 20% stake? I paid another 4,000 in terms of acquiring the stake. And where does the balancing figure go? Soki. You can directly take equity as a debit. So we take the balancing figure equity and that is to the extent of 2,000. The entry is done. Oh my God, look at the size of the question. And look at the answer. It's cute. In this case, if you notice, we are not in this example. We are not required to apply much of the mind for the simple reason that in this particular question, the status of the NCI on the date of further acquisition was given. Since the NCI on the date of acquisition is given, we know it's going to proportionately decrease. So we made a proportional reduction in the NCI and the payment is already given. Simple. Let's go to the next one. This was a case of further acquisition. Now we're going to see the case of disposal, and that's again still block number 1, that there is no loss of control. Let's see. It says entity P sells 20% interest in a wholly owned subsidiary. That means there was no NCI which was there in the books of accounts. Once you're going to sell the shares, you need to create an NCI. It says outside investor for 100 lakhs in cash. The carrying value of the net assets is 300 lakhs, including a goodwill of 65 lakhs. By the way, if you acquired 100% control in the company, the goodwill identified is full or partial. Think carefully and answer. When you're looking in terms of 100% acquisition in the company, the goodwill identified is full or partial in nature. That's right. The goodwill in this particular case is full. We can undoubtedly say the goodwill is full. Because when you acquire 100% stake in the company, the goodwill is full. The goodwill is full or partial distinction only when the NCI is there at personal or fair value. If there is no NCI, goodwill is always full. So which means now when he tells me that the net assets including the goodwill is supposed to be 300 lakhs. Now let's see what is the entry we are going to pass in this particular case. So let's, I think, put this entry 100 to 80%. So we can put this entry, that is disposal would be bank account gets a debit. So we sold the investment to the extent of 100 lakhs. And the NCI gets a credit, and we can comfortably take 20% of 300 lakhs, and this is going to be 20% of 300 lakhs, 60 lakhs is the NCI. So indirectly, I am considering the NCI at a fair value at this stage, because when you take the net assets, which is 300, including goodwill, we are taking fair value. So there is a balancing figure, which is 40, which is going to be taken directly in terms of equity. Simple and straight. This is 40. So this is 100, and the balancing figure, this is 40. Great. So I think this is done. We are taken care of the two cases. My block number 1 is done. So whether it's a case of a disposal or whether it's a case of an acquisition where the control continues, in this particular case, you just need to put the entry NCI bank, bank NCI, balancing figure equity, done. Simple and straight. Let's go ahead. Now let's take some questions based on the block number 2. So let me just, I think, shift it out here, so we can have a little more clearer picture of the permutations and combination. Okay, I hope friends visible. I know the page is a little small, but I hope if the visibility is okay, you can watch the question right. Okay, great. So we'll begin with the first one. Let's have a look at the question. It says a parent purchased 80% interest in a subsidiary on 1st April X1 when the fair value of the subsidiary's net assets is 175. So we got the stake at 160, and it says goodwill of 20 arose on consolidation under the partial goodwill method. He's very clearly said the goodwill is supposed to be partial, which means NCI is at PASNA. We can even calculate, if you consider 175 net assets into 80%, so 160 versus 140, 20 is the goodwill. So this indicates that NCI is supposed to be at PASNA because it is a partial goodwill in this particular case. It says an impairment of goodwill 8,000 is charged in the consolidated financials for the year ended X3. No other impairment charges are recorded. The parent sold the investment on 31st March for 2 lakhs. The book value of the net assets is given on the date of sale, which is not including the goodwill. When the subsidiary met the criteria to be classified as held for sale under Ind AS 105, no write-down was required because the expected fair value less cost to sell was greater than the carrying value. I think I'd like to also remind you one more thing, which I think I made a mention at the start of Ind AS 110 as well. That, when you look at a subsidy which is acquired with the purpose of resale, or you already have a subsidy and you're planning to sell off the subsidy, Ind AS 105 will also get triggered. The investment in the standalone financials and even for consolidation, Ind AS 105 will trigger. And the moment the non-current asset held for sale is classified, it needs to be recorded at book value or the fair value less cost to sell, whichever is less. So in this particular case, it says that it was classified as held for sale, but there was no write-off because the net fair value was greater as compared to the book value. So impairment loss under 105 did not occur. The parent carried the investment in the subsidiary at cost as per Ind AS 27. Now we are required to calculate the gain or loss in the separate financials and the consolidated financial statements on 31st March X4. So let's do one thing. We'll take two set of entry, one for the consolidation point of view, one for the separate financials point of view. Let's begin. So I'll do the figures out here. Now we can clearly see in this case there is a full disposal. If it is a full disposal, that means I need to do the reversal entry under Ind AS 103. My advice is when you do such questions, you first organize the GIL entry and then we'll concentrate on the figures. So we can put the entry bank gets a debit. Then we can take the investment retained if any gets a debit. Right now putting a generic entry. So I'm not concerned whether investment is there or not. So bank gets a debit for the money received. Investment gets a debit. NCI gets a credit. NCI gets a debit, sorry. Goodwill gets a credit. And the net asset gets a credit as well. And any difference will be taken in the P&L. So first you organize the generic entry and then start looking at the figures. Let's see what is the inputs given. The parent sold the investment for 2 lakh, so bank is going to be recorded at 2 lakh rupees, the value at which investment is sold. And then it very clearly says the goodwill was identified at 20,000, but there is an impairment of 8,000. So goodwill which is still appearing in the books of accounts is to the extent of 12. Because we need to take the goodwill which is there on the date of disposal post the impairment loss. And we are also given the status of the net assets, and we are given, it says the book value of the net assets on the date of sale is 225, not including goodwill. So we take the net assets as 225, not including the goodwill 12. And we've already de-recognized the goodwill separately, so the net asset is of course excluding goodwill. Investments is not retained because we sold off the entire investments. And the only thing to be taken is the NCI. So for the purpose of NCI, we now need to get the focus. NCI is at Pasna. If the NCI is at Pasna, it will be appearing at a share in the net assets without any goodwill, which means out of this 225 net assets excluding goodwill, since we had an 80% stake, 20% is the NCI on the date of disposal. So you need to be very clear that since your NCI is at a Pasna, when you calculate the NCI, it is a share in the net assets. So 225 into 20% works out at 45,000. Let's see the balancing figure in this entry that becomes again a loss. So let's see what is the balancing figure in this entry. This is 245 minus 237, I guess. We're getting a balancing figure 8,000, is it? So we get a balancing figure on the credit side, that is 8,000. This will be taken in the P&L. This is a profit on sale. This is the inputs profit on sale from the consolidated financial statements point of view. So when you're calculating the profit on sale, this entry is valid from the consolidation perspective. Let's go ahead. Let's also see in this particular case now that if I were to calculate a profit from the separate financial statements point of view, the calculation of profit and loss on the separate financials is exactly the way you do in a normal accounting. Compare the sale proceed versus the cost of the investment. So we sold the investment at 2 lakh rupees, and if you compare the original cost of the investment, we acquired the investment at 1.6 lakh. So there is a profit to the extent of 40,000. This is going to be taken in the P&L. So he says we need for the separate and the consolidated financials, what is the profit on sale, right? I hope, friends, you got the picture now in terms of the block number 2 as well. Because block number 2, your full concentration is on the reversal entry 103. Let's see more questions with you. Let's have a look at another question where you're converting into a passive investment. It says A purchased 100% subsidiary on 31st March X1 when the fair value of the net assets is 40 lakhs. Therefore, the goodwill is 10 lakh. Is it a full goodwill or is it a partial goodwill? As it is, you got 100% stake, which means what? That there was no NCI. If there was no NCI, can I say this goodwill is supposed to be full only?
Yes, sir.
Then he says A Limited disposes of 90% interest, leaving a 10% investment. At the date of disposal, the carrying value of the net assets excluding the goodwill is given. The fair value of the remaining interest is given. Assume for simplicity pro rata fair value of 90% sold. So he's taken the value at which 90% is sold. He's taken that as a base to calculate the NCI. Something like this, 85.5 lakhs is for 90%. So what is the value for 10%? He's just taken a proportionate value. 85.5 represents 90%, so 10% is 9.5. Considering the fair value of the retained investment proportionate to the figure sold. Calculate the gain or loss in the separate financials and the consolidated financials on 31st March X1. Here again, we're going to first look at the reversal entry under Ind AS 103. So let's, I think, organize the data. Let's consider the consolidated financials where we will consider the bank gets a debit, the investment retained gets a debit, the NCI to be derecognized gets a debit, the goodwill gets a credit, and the net asset gets a credit, and the balancing figure gain loss will be taken in the terms of P&L. Let's now pick up the figures again and just put in the figures. It says A disposed of the investment at 85.5 lakhs. So this is the bank figure. He's also given you the investment retained is 9.5 lakh. So the investment retained comes at 9.5. And as far as the NCI is concerned, we are 100% stake in the company. So there is no NCI in the books of accounts. And then we consider the goodwill as well. The goodwill is to the extent of 10 lakh. I don't think so there has been any impairment. So the goodwill derecognized at 10 lakhs itself. See how simple it is. And then there is a net assets as well. On the date of disposal, the net assets is supposed to be 80 lakhs. That is excluding goodwill. You've already taken goodwill separately. I'm done. Can you trust this is so simple? Doesn't make a difference. So let's see the balancing figure, 85.5, 9.5. Are we getting a profit of 5 lakhs on the profits, I guess? I think there is a balancing figure 5 lakhs, which will enter the P&L, the gain on disposal. Okay. Let's also see what is the profit or loss from the separate financial statements point of view as well, which is simply going to be a sale proceed versus the original cost of sale. So let's see what is the value at which investment is sold, 85.5, and what is the value of the original investment. Can you tell me what will be the original cost to be considered for the sale? I've not sold the entire cost. I've sold only 90% of the investment. So can I say 50 lakhs into 90%? Correct? That's right, 45 lakhs. So we get a profit on sale. 85.5 minus 45, that works out at 40.5 lakhs is the profit on sale for the separate financial statements. Right. Let's now go further. By the way, how are you finding the techniques? Isn't that simple? Block 1 was simple, NCI Bank. Block 2 is a reversal entry, Index 103. I think the only focus is getting on the NCI. And you can get full-fledged questions also, which we're going to see later, which are given the study mat, where he is going to ask you to incorporate this entry as a part of the consolidated balance sheet post the sale. Okay, let's now go to the next question as well. And let's see 100 to 70. This is now a case where you are still going to continue in a control, I guess. 100 to 70 would mean still under control. Okay, I think I wanted to take something different. Okay, anyway, let's, I think, look at this part also. 100 to 70. It says entity A sells 30% interest in wholly owned subsidiary to outside investors in an arm's length transaction. And it retains a 70% controlling interest. So this is a case where there is no loss of control. By the way, block 1 or block 2? Is this going to be block 1 or block 2? Because all these questions have been block 2, but this is 100 to 70. So this is block 1 or block 2? Block 1. Then he says at the time of sale, the carrying amount of the subsidiaries net assets is 1300 crores. Additionally, there is a goodwill of 200 crores arose on subsidiaries acquisition. Entity A accounted for NCI presenting the ownership interest in the subsidiary at a fair value. The NCI is at a fair value, which means the goodwill is supposed to be full. And it recognizes the subsequent changes in the NCI, which is the proportion share in the net assets and goodwill. How should A account for this transaction? That means a disposal. I think I'll just put this entry on the side if I've got space. So let's, I think, put this entry out here itself. So this is a case where we can, I think, let's put it here only. So we made a sale. So the entry is going to be bank gets a debit and the NCI gets a credit for the disposal. I think let's now get the inputs at your side as well. Can you tell me in this case, what is the value at which the bank will be recorded? Very apparently given in the question. It sold the investment in cash, which is for 500 crores. So I can say this is 500 crores.
NCI
I think the only, yes, the only input which I need in this particular case is NCI. So let's get the NCI from your side. So we are given that as far as the net assets on the consolidated balance sheet sale is concerned, it is 1300 crores with a goodwill of 200 crores. So can you quickly give me what will be the amount of NCI? Remember, the NCI is at a fair value. If the NCI is at a fair value, the goodwill is supposed to be full. And if the goodwill is supposed to be full, the NCI is going to be taken at net assets plus a goodwill. I thought I'll get the answer shooted out fast. Oh my God. This is clearly given. The net assets is 1300 crores and the goodwill is 200 crores. So can I say the net assets plus the goodwill is supposed to be 1500 crores? Out of this 1500 crores, 30% is the NCI. That makes it 450 crores. So this is going to be 450 crores. So we get a balancing figure, 50 crores. This is going to be taken as a part of equity, that is retained earnings. Simple. Right, so this takes care of this particular situation as well. Aha. Now we can take another question as well. Yes, let's take one more question before we'll come to the questions in the study material with you. Let's now go to another question as well. This is a case where you need to help me out. I think I'll just put this on the left to get my answers on the right. Okay, now this is testing time. I've done so many questions. I think I've done around 5 questions already. So this is the 6th question testing time. I'm just going to read the questions. Help me out with the data. It says A acquired another 10% additional shares at a 70% subsidiary. So can you tell me this is block 1 or block 2? I think that you can decide. Block 1 or block 2?
Block 1.
Wonderful indeed. It's a case of a further acquisition. So I know this is block 1. So I know the entry will be bank NCI. The following relevant information is given in respect of the change in the NCI. So you're given these separate financials, investments at cost is given, and the purchase price for the additional 10% interest is given. The NCI at 30% is given, and the consolidated P&L balance and goodwill is given. The reporting date is 31st March 20. We need to show the change in the NCI and should goodwill be adjusted for the change. So first question, is the goodwill going to undergo a change? Yes or no? Is the goodwill going to undergo a change in terms of this case? No, because in this case, the control continues. So the only entry which I need to put is on the further acquisition, NCI gets a debit, bank gets a credit, and the balancing figure equity. So let's get the inputs from you. First, give me what is the bank figure. You've acquired another 10% stake. बसंती तुम्हारा नाम क्या है? What is the money paid in the bank? Basanti, तुम्हारा नाम क्या है? Oh my God. That's right, 2600. And then let's consider NCI. Now, NCI is what you're going to calculate. Please tell me the NCI. Remember, the earlier NCI was 30% and now the NCI is reduced to 20%. There is a 10%, or I can say there is a 1/3 decrease in the NCI. I'm already given the status of the NCI on the date of disposal. What else can be given? This is the NCI 6600. So there is a 10%, or I can say 1/3 reduction. Oh my God. Tell me, what is the reduction in the NCI? 2200, friends. 6600 is the NCI, and apply simple basic maths. 1/3 reduction in terms of NCI. And you get the balancing figure is going to be taken in the equity. So the balancing figure 400 is debited in terms of equity. That was simple and straight. This is the calculation of the further acquisitions with reference to the consolidated financial statements. So I guess my base is done. I want to do some more questions now from the study material as well, because we've got some full-fledged questions that after the disposal, what is the status of the consolidated balance sheet as well? Okay, but I think it's time to give you first a break at this stage, and then we continue with this more questions on the changes in ownership interest. Let me see if there is any questions coming in between so far. No, all good to go. Okay, right, friends. So we'll take a break, 10-12 minutes, and I join you back after the break. Enjoy your break. Okay. I guess so far so good. I don't think so we've done so much technical inputs at this stage. There is a particular question, which is given in the study mat, which is a bit technical in nature, but we just kept it aside for the time being. Let's now go on to some more questions on the changes in ownership interest, where we're also required to make a consolidated balance sheet as well post the disposal. And there is another concept which is still pending, the concept of a deemed disposal. So let me just share some questions to you from the study material as well. So I guess first we'll go to the question on a deemed disposal, which is given in the study mat. And then we'll see a full-fledged question as well. Or maybe we can first go for an additional stake question. Just give me a... Yes, I think we'll first come to the concept of a deemed disposal in this particular case. Right, so this is a good question. This is a question on the concept of a deemed disposal, illustration number 30 of the study material. It's a pretty simple question, but of course, a little different from the normal routine. So first we'll do deemed disposal, then we'll come to a full-fledged question. It says in March X1, a group had got a 60% interest in a subsidiary with a share capital of 50,000 ordinary share. The carrying amount of goodwill is 20,000, calculated using a partial goodwill. That means NCI is taken at a pasna. If it is a partial goodwill, the NCI is taken at pasna. Then it says on 31st March X1, there is an option which is held by minority shareholder, exercise the option to subscribe a further 25,000 shares in the subsidiary at the rate of 12 rupees per share, raising a total of 3 lakh. The net assets of the subsidiary prior to the options was 4 lakh 50, which is excluding goodwill. Calculate the gain or loss of interest in the subsidiary due to an option which is exercised by the minority shareholder. Now you can see something very interesting in this case, that as an investor, I am not doing anything. I've not made any sale of shares. It is only that the minority shareholders have subscribed for more shares in the subsidiary, due to which the percentage, my percentage, undergoes a change. So let's first look at the chart. For a second, the Alexity went off. Okay, just give me a second. The file is just getting uploaded. Hope it gets saved as well. Okay, so let me just come back on the disposal, deemed disposal question, which I was mentioning. Right, here we are. So let's come back on the question out here. So we were doing the calculations. As I said, in this particular case, there has been no action which is taken by the investor. The investor did not do anything. It's only the minority shareholders who acquired more shares in the subsidiary, and that changes the percentage of the investor. Now let's organize the data which is already organized here. So we're just going to look at this. Now, if you look at the status before the deemed disposal, I would call it as a deemed disposal, there were a total of 50,000 shares, out of which 60%, that is 30,000, is with the parent company, the investor. Now, what happened? 25,000 shares were further issued by the subsidiary. That makes it 75, but you're still there left with 30,000 shares in the company. So automatically, your stake turns out to be 40%. So what is happening? Because of the increase in the capital base of the subsidiary, you still with the same N number of shares, and that changes your percentage stake. Just to show the calculations once again out here. So we can say what was the status before and what is the status which is after. So we very clearly know in this particular case that the subsidiary had a total of 50,000 shares in the share capital base. Out of which 60%, that is 30,000 shares, are there with the parent company. So he has got 30,000 shares irrespective of what has happened. But the problem is that if you look at the total number of shares earlier, the total number of shares was 50,000. But once the minority also subscribed for another 25,000 shares, the total capital base of the subsidiary company underwent a change. So earlier he had a 60% stake, 30 by 50. Now he's got a 40% stake, which is 30 by 75. So automatically what happens that without even making a conscious sale, the control is gone. So this is called a deemed disposal. This is called a deemed disposal, wherein you did not take any kind of action, but still the disposal took place. So this deemed disposal is under the loss of control. As in the chart earlier, I had also reflected a case of a deemed disposal. So would the accounting be different as compared to what we have done earlier? No. It is a case of block number 2. So I'm going to put the same entry, the reversal entry of Index 103. So let's do one thing. Let's organize the entry and then put the figures. So bank will get a debit. Investment retained would be getting a debit. The NCI will get a derecognition debit. Goodwill is going to get a credit. And the net assets is also going to get a credit. So we'll just organize the information and get the balancing figure, profit or loss on disposal. Okay, let's, I think, begin with, first of all, the investment sold. We did not sell anything, so there is nothing in the bank. Because we never sold anything, so bank doesn't get a debit. Now, what about the investment which is retained? I'm nowhere given in the question that what is the fair value of the investment which is retained, but we can comfortably consider that the value at which the shares were subscribed by the minority, that can be taken as a base. So we know that they acquired the shares at the rate of 12 rupees per share. So we can use that and we can say the investment retained is 30,000 into 12. So this investment will work out at 30,000 into 12 rupees per share. So this works out at 3.6 lakh. Now, as far as the NCI is concerned, yes, NCI in this particular case is supposed to be now derecognized because he had recognized a 40% NCI. So there is a need to derecognize the NCI. So let's see what is the NCI. I guess since the NCI is at Pasna, we are given the net assets is 450 excluding goodwill. So we can take the NCI that is supposed to be 4,50,000 net assets into 40%. Because now for me, the NCI, which is already in the books of accounts, gets derecognized. And I think that works out at 1.8 lakhs. Next, let's also consider the goodwill calculations as well. The carrying amount of goodwill is appearing at 20,000. That gets derecognized. And as far as the net assets is concerned, it is 4.5 lakhs. And we can get the balancing figure in this entry. So you can see one thing, that in this particular case, in spite of the fact that there has been no actual disposal, the entry still can be done under Ind AS 103 reversal entry. In this particular case, since there is no actual disposal, the bank becomes zero. Otherwise, we just take the same entry. Let's see the balancing figure. This is, I get 4,70,000 minus 180 minus 360. I think we are getting a gain of 70,000. So I'll just put it out here. P&L gets a credit to the extent of 70,000 on the credit side of the entry. Simple. Now, I guess if I go back and look at my chart, I think I've covered up all the permutation combinations with you. Let me just go back to the chart and see if you have covered all the permutations and combinations so far. So what we started off with the permutations combination, let's see if all those inputs are done. Let's have a look now and see if all the permutation combinations are taken care. I guess no loss of control for acquisition, done. No loss of control disposal, done. Deemed disposal, done. And full disposal, done. And converts into an associate. I don't remember, did we do a conversion to associate as well? And converts into passive, I think is done. Did I also do conversion to associate? I don't remember. But did we? Okay, yes, I wasn't present. Okay, no, I did it today only, beta. So did I do this converts into associate today? I don't know, but I think I've covered up all the permutations, combinations, I guess. Yes, this I think is done. Now I want to go to a comprehensive question, which is illustration number 24. So let's go to the illustration number 24 now. This is a question where you're asked to make a consolidated balance sheet post the disposal. Just give me a second. So let's have a look now at illustration number 24. This is going to be a full-fledged question, which is post the disposal, how things are taken care of. Okay, you just came back. Okay, that's okay. I think if anybody remembers, we did the case of associate conversion. I think no. Did we did a question on conversion to associate? That should be pending because, that is one dreaded question which I intentionally have not done so far. Okay, so let's go to the illustration number 24 now, which is a full-fledged question. It says A acquired a 70% shares in B when the fair value of the net assets is given. During X0, X1, B made a profit of 100 lakhs. Individual and consolidated financials on March X1 is given. And then further it says out here, it says A acquired another 10% stake on 1st April X1 for 32 lakhs. The proportionate carrying amount of NCI is given and show the individual and the consolidated balance sheet of the group immediately after the change in the NCI. Now what we are required to do is we are required to show the balance sheet which is separate financials and consolidated financials post acquisitions. Now I want to do a little more discussions more than what the question is asking for, because I did this discussions at the time of Ind AS 103 as well, and I'm a little more interested in giving you 3 cases as of now. So let me now give you, before I solve this question, 3 mappings in a map of mind. Now watch this carefully. The next 10-15 minutes is going to be a little more crucial to watch. So let's have a look out here carefully. I'm now going to cover 3 aspects what is coming to my mind. Because when you see the questions on consolidation, one is a plain vanilla questions, where you're just given some data and you're required to make a consolidated balance sheet. But now I'm looking at some special kind of situations, which is a blend of 103 and 110, or a blend of disposal, or a blend of further acquisition. So let's see 3 cases one by one. I'm looking at, first of all, a situation number 1. I'm looking at, first of all, a situation number 1. Now watch this carefully. I am looking at that, for example, you are moving towards a control. I'm looking at you're moving towards control. You did not have a control. So there are 2, I would say, situations. This is my existing situation, and this is my proposed situation. Just to give you a clarity, let's have a look at this. Let's consider under the existing situation, you had no percentage at all, 0%. And you're moving to a situation where you get a control, that means more than a 50%. Or there could be a situation where you are a passive investor, or you've got a significant influence and you are moving towards a control. This is not a change in the ownership interest area, what we are discussing. Please mind the words carefully. What I'm discussing in the change in ownership interest is the case when you are in control and continue in a control. But here I'm looking at you are not having a control and you're moving towards control. So situation number 1 is more like a step acquisition. Situation number 1 is more like a step acquisition. I remind it again, it's not a part of the changes in ownership discussion. The changes in ownership interest is being defined in 2 parts. Number 1, you're looking at a situation where there is a control, you continue with the control, or there is a control, you lose it. This is not a change in ownership interest. This is a previous case which we are discussing that is called a step acquisition. Because you need to be very clear which situations the examiner is giving you in the exam. Now, watch this. In this particular case, when it is a case, this is rather a step acquisition. This is not even a step acquisition. Now, what are the entries you pass in the separate financials and in the consolidated financials? That's what we want to see. So we can say if you're looking at a separate financials, that is Ind AS 27. The moment you acquire an investment, you put the entry that is investment gets a debit and the bank gets a credit, and this is with the cost of the investment acquired. So in this case, when you get a control or you're acquiring a further percentage, this is the entry which you do in the separate financial statements. Now, what do you do in this particular case? You do the entry under Ind AS 103. You do the entry under Ind AS 103, which is on the date of acquisition. Since it is moving from a situation which is a step acquisition or maybe a direct control acquisition, you are putting this entry, net asset gets a debit. Rather, let me do one thing. What are you going to do? First of all, you are going to take care of the PHI, I would say. I would say you're going to take care of the PHI, and what you're going to do in terms of the PHI, you will update the investment. So investment gets a debit and the gain enters the P&L or the OCI as the case may be. This is what we can say a fair value upliftment. This is what we can say is the fair value upliftment of the PHI. This is what you do first of all. I hope you get the chain very clear. So what we need to do in this particular case, whatever is the existing investment, you uplift the fair value of the previously held investment. And then you go for the Ind AS 103 entry, that is net asset gets a debit. Fair value, the investment gets a credit. This is including the PHI. So the investment gets a credit including the PHI. And we take the amount of NCI as a credit, and you get a goodwill as a balancing figure. You get the goodwill as a balancing figure in this particular entry. So this is one kind of situations you have done. I'm just merging the concept of 103 and the concept of 110. So in this particular case, if it is 0 to control, you put this entry only. And if it is a case of a passive or a significant influence to control, you first of all do this entry of upliftment and then you put this particular entry. And as I said earlier, if you just, incorporate this entry in the Ind AS 103 entry, you're going to get the consolidated financial statements as per Ind AS 110, which is on date of acquisition. So if you merge this entry, this is the entry which is in the separate financial, the investment is appearing, this investment gets de-recognized, and when you incorporate this entry, it gives you Ind AS 110 consolidated balance sheet. This is what you did in a question Professional and Dynamic Limited as well. To just remind you in terms of Ind AS 103. This is what you did in the question Professional and Dynamic, which was given in Ind AS 103, but you made a consolidated balance sheet on date of acquisition, which was nothing but based on the merger of this. And thereafter, you keep making a consolidated balance sheet year by year purely based on Ind AS 110. This is one case. Now, let's go to the next one. I'm now looking at a situation number 2. I'm now looking at a situation number 2, a full-fledged question now. Because one is that the examiner will put you entries for just, a loss of control or no loss of control, a separate entry is done. Now let's see if it is a case of no loss of control. It is a case of no loss of control. If it is no loss of control, no loss of control would mean that you were having a control, you acquired further stake, you were having a control, you dispose of the stake. So this could include, you can say, further acquisition also. This include the case of further acquisition, or this could also include the case of disposal, both. So it would be a case of further acquisition or disposal. Now, in this particular case, the examiner could give you a balance sheet pre-further acquisition or pre-disposal. So he gives you, in this particular case, the examiner gives you a consolidated balance sheet, which is pre-further acquisition. He gives you a pre-further acquisition balance sheet, or we can say pre-disposal. A consolidated balance sheet is given in the question, which is before considering the further acquisition. The illustration number 24, what we're looking at. So he gives you a pre-acquisition or a pre-disposal balance sheet. Now what I'm going to do in this particular case, I will incorporate the entry. If it is a further acquisition, then it is NCI debit and bank gets a credit. Or alternatively, it is bank debit and the NCI gets a credit. So this is the entry which is done for the purpose of further acquisition, and this is the entry which is done for the purpose of disposal. And any balancing figure in these entries are taken as far as equity, that is retained earning, is concerned. So what do you need to do? You already have this balance sheet with you, and this is the entry which is done. Merge it, and you're going to get the consolidated balance sheet. The result would be you will get the consolidated balance sheet, which is post further acquisition. It is going to be post further acquisition, or it is supposed to be post, you can say, disposal of shares, because the control is not lost. Mind it carefully. The control is not lost. When you say the control is not lost, so the examiner could ask you a question to do only this entry, or he may ask you to make this balance sheet as well. So he will give you the status of the balance sheet pre-further acquisition and disposal, and you need to just incorporate this entry within this balance sheet, and you get the final balance sheet, which is post-acquisition disposal. That can be one larger question. Now let's see the case number 3. Now let's see the case number 3. This is situation number 3, what we are looking at. So in terms of situation number 3, we are looking at the case of loss of control. We are looking at the case of loss of control. In this particular case, if the control is lost, there is going to be no consolidated balance sheet post acquisition unless it converts into an associate relationship, mind you. unless it converts into an associate relationship. So in this case, whether he gives you a balance sheet pre-disposal, he cannot ask you a balance sheet post-disposal unless it is Ind AS 28. So I think let's give you two situations. If there is a loss of control, it is always a case of disposal. It's never a case of further acquisition. So please get the chain very clear as I am giving the inputs. The situation number one is a case where it's a control in one go, or it is a control which is step acquisition. Two, as I said, there are two cases in this case. It is a control in one go, 103 entry. It is a control which is step acquisition, PHI updation, and then 103 entry, and then you can make a consolidated balance sheet which is on date of acquisition. And if it is subsequent, then it's more like an independent question on a consolidated balance sheet. The second input I gave you that there is a loss of control. You acquire more shares or you sell shares, but the control is there and the control continues. So what do you need to do? The examiner could give you a balance sheet pre-acquisition disposal. You just incorporate this entry and get the balance sheet post-acquisition or post-disposal. Done. Third. The third is a little crucial point when you're looking at a disposal. When you're looking at a disposal, it could be a full disposal, or it could be a case of a partial disposal, which could mean conversion into a passive investor. That's one. So I will say, if you're looking at 100% disposal, if you're looking at 100% disposal, or you're looking at a partial disposal, or you're looking at a partial disposal, which is converts into passive investor, So in this particular case, we can say the consolidation is not going to happen later. Because once you dispose all the shares, or in this particular case, you are disposing the share and it turns to be a passive investment, there is going to be no consolidation. So in this particular case, if you ask me, I would say there will be no consolidated balance sheet which is made post-disposal in this case. There is going to be no consolidated balance sheet which is made on a post-disposal. So he can only ask you an entry. That's it. So in this particular case, he will not ask you to make any consolidated balance sheet. He will only ask you, the question will be asked only on journal entry. They will ask you a question only on the journal entry, which is the reversal of Ind AS 103. That's it. I hope you get the picture. Next. If you're looking in terms of the disposal, which is a partial disposal, which is supposed to be a partial disposal, where it converts into associate, where it converts into an associate company. So when it converts into an associate, consolidated balance sheet will be required post-disposal as well, because consolidation was taking place as a subsidiary. Now consolidation will take place as an associate. The consolidation will continue. So in this particular case, consolidated balance sheet will be prepared. Consolidated balance sheet will be prepared post-disposal as well. Consolidated balance sheet is going to be prepared even post-disposal as well. Now, in this case, when you go to make a post-disposal balance sheet, it would be a switch over from 110 to Ind AS 28, where the investment will appear one line. We do not have a question in the study material on this particular area, but your conceptual understanding can help you to do such kind of questions. So in this particular case, what you need to do, we need to switch over from Ind AS 110 consolidation to Ind AS 28 consolidation technique. That's a one-line consolidation. But you will be able to do this question only after we are done with Ind AS 28. So at this stage, you just need to know the conceptual part that this will be a switch over. So in this particular case also, can the examiner give you a balance sheet pre and then you need to make a balance sheet post? Yes, of course. And you will basically do the same exercise of incorporating the disposal entry and making the consolidated balance sheet as well. But I'm not getting into the complications, but please remember this part. So moral of the story, that in cases of changes in ownership interest, I'm not talking of situation 1, I'm talking of situation 2 and 3. In case of changes in ownership interest, if it is no loss of control, the examiner could give you only entry-based question, or he could give you a balance sheet, consolidated balance sheet based question, giving you a balance sheet pre-acquisition or disposal, and you need to make a balance sheet post-disposal or acquisition incorporating the entry. And if it is a case of loss of control, in those cases, unless it's a conversion to associate, the examiner cannot ask you to make a consolidated balance sheet. He can only focus on the journal entries. And if it is a conversion to associate, he can put you into entries as well. He can put you into making a consolidated balance sheet as well. I hope, friends, you got my position 100% clear. Got the point, I guess. Great. Now I want to come back to illustration number 24, which is basically on the situation number 2, which we are discussing. So let's go back and let's have a look at illustration number 24, what we were looking at. So I'm just going to go back to the illustration number 24 and see that it clearly falls in my situation number 2. It says acquisition of an additional stake in a subsidiary, which means it's a clear-cut case of further acquisition where there is no loss of control. So he says that this is the standalone balance sheets of A and B, and this is the group that is consolidated financial statements. So individual and consolidated financials are given. So he said that we acquired a 70% stake when the fair value of the net assets is given, and during the year some profits are made. So this is the balance sheet which is supposed to be March X1. Then he says in this particular case A acquired. Then it says in this case A acquired another 10% stake on April X1 on 32 lakhs. And the NCI is 30, show the individual and consolidated balance sheet after the change in NCI. So it's a movement from 70 to 80. So we know that it is a case which is no loss of control, bank NCI change. Let's do the entry. Let's do the entry in this particular case. So since it is acquisition of further stake, we need to put the entry NCI gets a debit and bank gets a credit. And once I've done with this entry, I will incorporate this entry in the question consolidated balance sheet and get my new consolidated balance sheet. Simple. Let's see the entry. So we acquired another stake at 32 lakhs. So this appears at 32 lakhs. And we need to see the calculations of the NCI as well. So as far as the NCI is concerned, if you look at the consolidated balance sheet in the question, the NCI is appearing at 90. Currently, there is a 70% stake, which means there is a 30% NCI. Now, the NCI is changing from 30 to, you can say, 20% because we are acquiring another 10% stake. So there is a reduction which is to the extent of 1/3. From 30, it became 20. There is a 10%, 1/3 reduction. So NCI should also decrease by 1/3. 1/3 means 30. So we can put this entry, NCI gets a debit to the extent of 30 lakhs. And the balancing figure 2 lakhs is going to be taken as far as equity, that is retained earnings, are concerned. So can I say now, my life is simple. What I need to do, I have the balance sheet before the disposal. Incorporate this entry. So you are given in the question the balance sheet which is pre-acquisition, pre-further acquisition. Incorporate this entry and you will get the consolidated balance sheet which is post-acquisition. That's it. So the only thing which I need to do, just make the changes in the RE, NCA and the bank figures and the consolidation is done. We're not talking on the separate financials, that we'll see. So let's go back and let's vouch this out here. We'll just quickly make a vouching out here. Is the goodwill going to undergo a change? Of course not. So the goodwill, of course, remains the same. Because when there is no loss of control, the goodwill does not undergo a change. You sell, the goodwill is intact. You buy, the goodwill is intact. Goodwill does not change. Because you're used to the concept of AS21, where you start calculating incremental goodwill on further acquisitions. No. The goodwill continues to be the same. Is the PPE consolidation figure remain the same? Yes. The PPE consolidation figure, of course, remains the same. No change. Let's go back. Then let's see that there is a cash to the extent of 230. Is this cash going to undergo a change? Yes. The cash will decrease by 32. So out of the 230, 32 goes out, and this is 198 because you are paying a cash of 32 lakhs in that entry. Let's go further. So we've got other current assets 93. Will that change? No. So I guess we've incorporated the bank figure on the asset side. Now we just need to take care of the NCI reduction and the equity. Let's go back. If you look at the share capital, would there be any change? No. So that remains at 200 itself. Then you go back and see that is there any other equity? Would this undergo a change? Yes. You took a balancing figure in the other equity, and this 870 will reduce to the extent of 2. So this becomes 868. This is minus 2. What is there in this entry? The loss which arose on the further acquisition. And the next we are given the NCI, that is 90, reduced by 1/3, that is 30. So this is a reduction to the extent of 30. Isn't life simple? When you're making the consolidated balance sheet post the disposal or post the acquisition, you just need to incorporate this entry, and the 3 changes will be the RE will change, the NCI will change, and the bank figures will change, whether it's disposal or whether it's further acquisition. Done. Now let's see, would there be any changes in the individual balance sheet of B? I guess as far as the individual balance sheet of B is concerned, why would that undergo a change? Because as far as the further acquisition is taking place, that's taking place in the stock market between the majority and the minority. So this balance sheet would continue to be the same itself. No changes would occur. So this balance sheet, of course, continues to be same. No changes would occur. What about the balance sheet of the parent company? Yes. Investments will change because he's paid 32. Investments will increase. The cash will decrease. That's it. So in this particular case, the investments of 150 will increase to 182 and the cash will decrease by 32. The rest should remain the same. So this became 182 and this became 168. You add that 32, you reduce that 32. The rest of the balance sheet remains the same. It's all common sense. So this was a question which is based on situation number 2. This is a question which is based on situation number 2. When you are looking at not only the entries, but also you're looking at the incorporation of the entry in the pre-existing balance sheets as well. I hope, friends, you got my picture absolutely clear. Situations 1 we did in Ind AS 103, situation 2 we did in Ind AS 110, situation 3, I don't know if you're going to see that in Ind AS 28 or not, because to my mind there is no question which is given in terms of switch over to associate and a consolidated balance sheet is required. But conceptually you need to know that even if you switch over to 28, consolidation does continue. Sometimes I feel there can be a separate chapter which can be created on the concept of further acquisitions and disposal. Because, when there is an application in terms of further acquisitions and disposal, a lot of permutation combinations could arise, and that could trigger thoughts in terms of what is to be done in separate and in consolidated financial statements. Brilliant. So you made it easy. Thank you very much indeed. Now let's see further. Let's go further. I guess I'm not doing questions which are similar in nature. Those questions can be done at your end. Okay, so this is, I guess, done. And deemed disposal is also done. Okay, here we have, yes, I think I didn't do this question now. I am ready to take you to the associate part as well. So let's have a look out here. Let me just crop it. Illustration number 32 in the study material. Now we're looking at illustration number 32 in the study material. Because I think this was one example which we did not do so far. So let's have a look at illustration number 32 now. Though through this question, I will also throw a little more light as well, because my intentions are also to give you something more through this question, because that question I think is given in the study material in Index 28, but I want to throw a little light through this question on that particular aspect as well. Let's have a look at illustration number 32. Then we'll do a little consolidation of the things as well. Though I think today was not very technical, but yes, a lot of things coming in. But yes, we'll do a little mind mapping also after this. It says 80 purchase 100% subsidiary on 31st March X1 when the fair value of the net assets is given. Therefore, the goodwill is 10 lakh. And it says 80 sold 60% of the investment on March for 6750. By the way, is this goodwill full goodwill or is this a partial goodwill?
Full goodwill.
Wonderful indeed, because there is a 100% stake acquired, so it is undoubtedly full goodwill. 80 sold 60%, leaving the remaining 40% as a significant influence. Switch over to a significant influence. At the date of disposal, the carrying value of the net assets, excluding the goodwill, is given. Assume the fair value of the investment in the associate, which is retained, is 45 lakh. We're required to calculate the gain or loss in the separate and the consolidated financial statements. We need journal entries. I think let's first concentrate on the consolidation and then on the separate financials. So we know, is this block 1 or is this block 2? Accordingly, we put the entries. Block 1 or block 2?
Block 2.
Absolutely. So this is a case of a block number 2. So we need to put the reversal entry in terms of 103. So from the consolidated financial statements, first record the entry, then we'll pen down the figures. So in this particular case, bank gets a debit. Then the investment retained, if any, gets a debit. NCI is going to be derecognized, gets a debit. Goodwill gets a derecognition credit. Net asset gets a derecognition, that is credit. Balancing figure in the P&L. I think let's now take your help in terms of things. I've done so many questions. So tell me, what is the figure at which investment is sold? I sold 60% investment. How much?
67,50,000.
Wonderful indeed. And what about the fair value of the investment retained?
45 lakhs.
Wonderful indeed. Is there any NCI to be debited or zero?
Debited, sir.
No, there is no NCI because we had 100% stake, so no NCI. Okay, and what is the credit to the amount of goodwill in the books of accounts? 10 lakhs, that's also clearly given. Now tell me, what is the credit to the net assets on the date of disposal? Very clearly given. Net assets on the date of disposal. Oh my God, 80 lakhs. So let's see, what is the balancing figure? 67.5 plus 45 minus 90. I think we're getting a balancing figure 22.5. Where do you put this 22.5? P&L or SOKI?
SOKI.
That's right. No, not so key. It's P&L. This is not block one. Block one goes to equity. Block two is going to be taken in the P&L. This is on the consolidated financials. Let's see the separate financials as well. Though I think you can match the answer. This is coming to 22.5. The calculations are done, but I have tried to give journal entries for easier calculations. 22.5. Okay, now let's look at the separate financial statements. We sold the investment at 67.5. Can you tell me what do I compare the sale proceeds with? Originally, we acquired the investment at 50 lakhs. So can I say we sold 60%? So what do we compare this with? 60% of 50 lakhs, right? 50 lakhs, we sold 60%, 30 lakh. So we get a profit on sale that enters again in the P&L, 37.5. And that's the result, 37.5 in the separate financials as well. Now, let me, I think, trigger the $1 million question to you at this stage. Though we are not aware in terms of how equity method is applied, and we will get this inputs later. So, but I still want to trigger your thoughts at this stage. Once we're going to learn the equity method, you will see that on account of the application of equity method, if you remember, even in terms of Ind AS 103, I had given you that the application of equity method could result in a credit in the OCI. Do you remember that question? Where we did the concept of OCI balance scrutiny in terms of PHI? Say yes. Nobody is saying a yes. Oh my God. Thank you. That's great. In terms of the PHI, if you remember, the application of equity method left some amount in the OCI. So in this case, if you are going to move over from a control to associate, will there be a need to push out some money from the other comprehensive income? Because now you are moving out of the standard Ind AS 28. Yes, but we'll see all that later. Because there is a question in terms of Ind AS 28 which talks about the conversion of a subsidy to associate, which is a beautiful illustration. I don't want to discuss this without doing the equity method. Now let's do one thing, friends. I think let's now add some mind mapping to you. I'm sure you'll need one at this stage. I've done a couple of discussions with you. So before we go this further, let's do some mind mapping in terms of a discussion. Let's begin. Let's create a little mind map to you. I am not looking at the inputs in terms of P&L. All that is done. My focus is now only in terms of 3 cases. We're going to make some brilliant chart based on our discussions on 3 situations. Try if you can answer them, at least, give yourself a self answer. If you can answer all this, that means you've got a good grip in terms of things. Let's begin. Let's make you a super duper chart on this. My mind is now working on 3 different cases. So my mind is working on 2 sets of financials and it's working on 3 different cases. We'll go one by one. We'll try to fill up the chart. If you can fill up this chart, your fundas are going great, I would say, at this stage. So let me break this in terms of 2 portions. And I am creating a structure where I am considering the balance sheet. One is separate, one is consolidated statements. I'm looking at a case which is a case of further acquisition, which is a case of further acquisition, where I'm calling this as a step acquisition, where I'm considering that there was no control earlier. There was no control earlier, and now you get a control. This is one block which I am considering. Second, I'm considering a case of a further acquisition or a case of disposal. A further acquisition or a case of disposal, in which case You already had a control and you continued with the control. So this is further acquisition. That means there was some PHI. So there's no control, but PHI was there. And here I'm looking at a case of disposal. And I'm looking at a case of disposal where you had a control and now the control is lost. I hope the chain is very clear at the back of your minds in terms of my thought processes. So I'm looking at a situation, there was no control, you got a control, but there was a PHI. Second, the control continues and the control is gone. I want to see the entries and the impact on the balance sheets in terms of separate and consolidated financials of the investor. Let's begin. Let's begin the journey in terms of things. Number one, when there is a further acquisition in terms of separate financial statements, what do you do in terms of separate financials? Do an ordinary entry, investment debit, and the bank gets a credit. That's it. So you put the entry, investment gets a debit, and the bank gets a credit. This is what you pay for additional stake. This is what you pay for the additional stake. Any other implications which will follow in the separate? Yes or no? The focus is separate financial statements, mind you. So apart from putting the entry for the further acquisition of the stake, anything else to be done in the separate financial statements? Yes or no in this particular case? No. Okay, now let's come to the consolidated financial statements. What are you going to do if there is a switch over to control? Can I say we are going to do the upliftment of PHI and we are also going to consider the Ind AS 103 acquisition entry, correct? So in this particular case, I would put it like this, that you need to first of all uplift the fair value of NCI, uplift the fair value of PHI. When you're going to uplift the fair value of the PHI, can I say the gain or loss will enter the P&L or the OCI as the case may be? Because if it is a control, if it is supposed to be a passive, you were under 109 and it could be OCI or FVTPL. But if you're under significant influence equity method, in those particular cases, it would be a situation where you have to go for P&L change. So I would say there are two things to be done, if you remember. One is that there will be a gain or loss. There will be a gain or loss on the PHI, which will enter the P&L or the other comprehensive income as the case may be. And do we need a scrutiny of the OCI? Can I say we need to put that OCI in the RE? If you remember Ind AS 103, where the amount in the OCI was taken to the RE and in terms of associate scrutiny decided RE or P&L, correct? So we need to transfer the OCI to P&L or retained earnings. This is all the details were done in 103. So if you want to see more details on this, please refer. In this particular case, I'll just put down an inputs out here. Details are in 103. We covered all the details in 103 on a step acquisition in this case. Okay, any other implications in terms of console? Are you going to make a consolidated balance sheet now onwards? Yes. So consolidated balance sheet. So we can say consolidated financials only. Consolidated financials are now going to be prepared. So they are now going to be prepared as per 110. So consolidated financial statements are now going to be prepared as per Ind AS 110. Great. So this is basically what we are again incorporating the inputs what we discussed in Ind AS 103, but to put it in one go. Let's go to the next one. I'm now looking at a case where there is a further acquisition or disposal. What is the entry to be done in the separate financial statements? Can I put the same entry here as well in the separate financials?
For purchase, yeah.
Yes, I can put the same entry here as well, because if it is a separate financial statements, you can put the same entry. This will be for further acquisition. This will be for further acquisition. And in terms of disposal, we'll just segregate the entry. Can I say this will be bank account gets a debit and investment gets a credit? Can I say this is pro rata? This is pro rata of original cost, correct? This is pro rata of the original cost in this particular case. And where will you take the balancing figure?
Profit and loss.
Correct. It will be taken in the P&L account at this stage. So when it is a case of disposal, we've done umpteen questions today. The bank gets a debit with the sale proceeds. The investment is to the extent of proportionate of the original cost and the balancing figure in the P&L. Now let's come to the case of consolidated balance sheet. Can you tell me what entries will you do out here for consolidation? Control to control. Control to control. Entry, is it block 1? Yes, it is a case of block 1. The entry is NCI gets a debit and bank gets a credit. Alternatively, we can say if it is a case of disposal, then in this particular case, the bank gets a debit and NCI gets a credit. And where would you put the balancing figure in this particular case too?
Equity.
That's right. This balancing figure will enter in the equity in this case. Are you going to make a consolidated balance sheet? Is it going to be continue to be prepared under 110?
Yes, sir.
Yes, undoubtedly yes. So the consolidated balance sheet is going to be prepared here as well. You will continue to make the console as well. Okay, so this is on the second situation, which is a further disposal or a further acquisition or a disposal where just an entry is done and then the consolidation takes place. Okay. By the way, just to highlight the inputs in this particular case to be on the safe side, does goodwill change or goodwill remain the same? To be on a safe side. In this particular block, if there is a further acquisition disposal, will the goodwill change or remain the same?
Remain the same, sir.
Correct. The goodwill does not change. Even if you're acquiring more shares or you're selling more shares, the goodwill does not undergo a change in this case. Great. Now let's come to the case of control is gone. So when the control is gone, it's a case of disposal. Can I do the same entry out here when the control is gone? This will be only a case of disposal. So can I say the entry will be bank gets a debit with the sale proceeds, the investments will get a credit. I'm not considering that it will always be a full disposal. So it can be a proportionate partial disposal. So we take the pro rata. We take the pro rata of the original cost in this particular case as well. The proportionate of the original cost will be taken. And what about the balancing figure in this case? Where will you take the balancing figure to?
Profit and loss.
That's right. The difference balancing figure will again be taken in the profit and loss account itself. Now watch this carefully. When you're looking at the last block, that is a control is lost. What entries to be done in the consolidated financial statements? So I guess, and I will also like to put out here at this. Can I say we'll put the Index 103 entry also, correct? Acquisition entry, just to be on a very clear-cut side. Now tell me, in the consolidated financials, what will you do? Are you going to put the reverse entry of 103 at this stage? Yes, of course. So we will put the reverse entry. We will put the reverse entry of Ind AS 103. So the reverse entry of Ind AS 103 is going to be recorded in this case, irrespective of any case. Full, partial, deemed, whatever. Okay, are you now going to make a consolidated balance sheet also after this?
No, sir.
Are you sure if it converts into an associate, then?
Twice.
Oh, yes. So I think you'll have to watch out under two cases out here. We can say if it is a case of conversion to associate. If it converts to associate. So if it converts into associate, and if it converts into associate, consolidated balance sheet will continue. So rather, let's say consolidated financial statements to be precise. So consolidated financial statements are prepared. Consolidated financial statements are prepared as per which standard? 11028.
108.
28 beta. It is 28 because now it becomes an associate. So consolidation will be done as per 28. And in other cases, will you make any consolidated financial statement? If it is other cases, would there be any consolidated financials?
Not required.
No. So there will be no consolidated financial statements which will be prepared in this case. So I've given you a complete super mind map, which is containing all the permutation combinations in terms of all three cases. When there is a step acquisitions, what you used to do in terms of 103. When it is a case of a further acquisition disposal where the control is still continued, and when there is going to be a control loss, the implications on the consolidations are very important, that if it is associate, then it continues. If it is not an associate, the consolidation stops at that end. Trust me, this takes care of the entire aspect of Ind AS 110. The consolidation standard on 110 is over, but the consolidation is not. Now we've got two more important standards coming in, that is Ind AS 111 as well as Ind AS 28 and a bit on Ind AS 27. So next three classes you are going to see these three standards, 111, 28 and 27 of course is not too deep. But mainly, I would say these three standards, and then the consolidation takes place. Now, you need to revise this entire standard in a cumulative approach and do this. Because tomorrow, I will be starting with the joint arrangement standard, that is Ind AS 111. Over to you, friends. Any questions coming on your side so far?
No, thank you.
So far, so good, I guess. That's great. So I guess that's all for the day, friends, on the consolidation. We'll start with the fresh standard tomorrow, Ind AS 111, that is joint arrangements with you. Thank you very much. I think, so please take the question in the next lecture, please. Okay, you mean to say the question May 24 examination one? Yes, maybe not tomorrow. I'll take it on Tuesday, if you don't mind, because tomorrow might have to leave a little early before the class, so I'll not take an extended one. So Tuesday maybe we can extend it and take that question as well. We will do that question, no problems. I'll do May 24 question with you in the class. We'll do that. Wonderful indeed. Right, friends, so time to bid you goodbye on this. So see you tomorrow. Thank you, bye-bye, and take care. Thank you, Ji.